Welcome to this special roundtable on Zoom post-budget analysis with three experts with their own specialization, with their own specialty, and their background. With me is Sandeep Tandon of Quant Mutual Fund. He has pioneered a democratizing of mutual fund with a unique strategy in recent years. Mahendra Jajoo of Mirae Asset, looking after fixed income funds for a long time, and Ajay Khandelwal from Motilal Oswal. They all bring some different specialty or different background on the table, and they are here for this special conversation post-budget. And it has made the whole working class cheerful, at least to begin with. So let me start with you, Sandeep. Given your fund's data-driven investment strategy, how do you interpret this, fiscal deficit targets and revenue assumptions in this budget? Do you see any risk of opportunities in the government projections for the equity market?
So, frankly speaking, Dhirinda, it's a quite well balanced between fiscal discipline as well as the growth. Okay. And I think it's a good combination of very coordinated efforts between fiscal and monetary responses concerned. So, from a let's understand what was the need. For last 6 months, Indian economy was degrowing and consumption was the biggest challenge. Though the rural economy is giving you some early signs of is coming back after maybe 4 years of COVID, but the urban area was slowing down, consumption particularly. So I think government has taken right steps, okay, though it looks like a populist budget, okay, but I think sometime it is required, and I think government has taken nice steps, and they have maintained the physical discipline also. So I'm quite constructive about the entire budget.
Now let me come to you, Mahendra, which is, the debt market outlook. The budget has outlined borrowing plans and fiscal consolidation targets. How do you see this impacting bond yields and, the overall debt market? And what is your outlook for the fixed income for the coming year?
So, I think everyone was watching as to whether the government is able to meet its fiscal consolidation target, given the slightly tight situation in terms of growth and the need to boost consumption and the capex to be maintained. And I think the government has not only met with its given guidance, they've outperformed it. So for the next year, FY26, the fiscal deficit target is at 4.4% as against the guidance of 4.5%. And as Sandeep said, I think government has balanced very well the different requirements of growth, consolidation, and giving a strategic guidance. So we have already seen the monetary policy stance becoming progressively accommodative. After remaining on pause for close to 18 months, RBI cut CRR in the last couple of months. They followed it with, trickle of buying of the bonds in the secondary market, and now they have announced slew of measures, including the dollars buy-sell swap, the open market operations, etc. And I think the government's commitment to the fiscal consolidation and the guidance to bring down the debt to GDP ratio to close to 50-51% in next 5 years will not go unnoticed as far as the RBI is concerned. We have the monetary policy review next week, and I am quite hopeful that RBI will further ease the financial conditions, take more measures to boost liquidity, which will further improve sentiments. We already have the 10-year bond yields at the lowest of the last 1 year, and I'm expecting more and more constructive fixed income market. This is coming in a backdrop of a global rate easing cycle starting. There is a bit of a concern with the long-term yields going up in US, but increasingly I think there is recognition that that is a local factor as far as the US is concerned. Even Jerome Powell said in the last FOMC meeting that the long-term rates going up in US is basically a redefinition of the term premium in the US market because of the local factors like inflation or fiscal deficit in response to the tariffs, etc. That do not correspond on a one-on-one basis for India. We have an economy which is losing momentum. We had 5 and 0.5% kind of a growth last quarter. So therefore, I would expect the Reserve Bank to progressively get more and more accommodative, which is obviously positive for fixed income. I'm looking forward to another constructive 2025 for fixed income.
Ajay, now you manage a very different segment of the market, like equity and small and mid cap. So this is major significant allocation to infrastructure and manufacturing. How do you see this driving earnings growth for companies in these sectors?
So my first take is that government has done the right thing in the sense that from the last budget, the capital expenditure allocation which was given in the budget, and they were not able to spend. So instead of doing 11 lakh crore, we ended up doing 10 lakh. Then it doesn't make sense you to have
Make that
allocation
allocation.
towards sectors where the expenditure is not happening. So I think the focus this time has been more on consumption. And last 2 years, we have seen how consumption has suffered, especially in the urban side. So given that construct, I think even this year, the defense allocation is still up 12% from the revised estimate to budgeted numbers for this year. So I think defense will continue to do well. But like last year, how roads and railways, for example, they were not able to spend the kind of money which was given. So there, I think in that sense, I believe these sectors will continue to have that kind of spend, which will be a little subdued. Sectors which will benefit, again, I think manufacturing will continue to do well, MSME especially because they have these credit guarantees also now coming into the picture. They have access to more financial muscle now. So that will help them. And given how we are progressing in manufacturing, some of these small businesses require that kind of financial assistance. So all in all, we are fairly constructive on these two part of market.
Do you think this is more of a giving some kind of backing or safety net, or it is real? It's going to be very impactful. The way we have seen the PLI is really taking off and bringing manufacturing on the forefront.
So now even in PLI, actually it was envisaged that they will do more than 2 lakh crore, but we have actually done only 25,000 crores. So these sectors which are benefited are the primarily electronics manufacturing, where we have actually met all the kind of whatever was the roadmap they were actually able to deliver. So the good part is PLI is based on delivery, where if somebody is not able to deliver, the wasteful expenditure is not happening. But some of these sectors clearly require. So for example, in this budget, I think footwear industry, they are given incentive and they are large job creators. So within the budget, 20 lakh plus employment generation and the kind of export numbers that are talked about are huge, 1 lakh crore plus. So clearly the focus is on those manufacturing industries which employ large pool of employment which can generate. And the focus is on both export and domestic market. So I think that way they've been careful which are those industries which require handholding and which are those industries where I think they are already reached at scale where it is not needed.
Sandeep, this has emphasized, this budget in particular has, green energy technology and your quantitative models. Will they get, quickly reconfigured to position these, will they be reconfigured based on these priorities set, your models? Do they adjust to it so quickly? And how rapidly it will be? What will actually you will get selective about in your portfolios?
So, there in the sense we are largely a macro house, and we are always said that whether you talk about energy in general or green energy in particular, I think it's a more of a decadal story. And so a longer term data point, whatever we have captured and thing. So we remain very constructive as a decadal opportunity. We are not talking about 1 quarter. So within the way we dissect our data, I always say that everything is not long term. Okay. So the way we have grown with a long-term thesis that everything is long-term, no, we don't buy everything from long-term perspective. We buy from a decadal perspective, long-term, medium-term, short-term, near-term also. Okay. So if I have to, let's say, energy, again, it's a decadal opportunity and we remain very constructive. I don't think anything has changed in this the current budget. Rather, it has only supportive whatever was the previous stand. So from our data perspective, I think nothing has changed. It's just a reaffirmation on those previous things.
So it only gets reinforced.
Yeah.
So what actually emerges as a special opportunity?
I think we have been talking about consumption should be a focus area. That's the reason our portfolio is already skewed. If you really, we could be the only mutual fund we could have like FMCG exposure to the tune of 15 to 18%. Okay. So that's exposure we already have in the system. That's our model was suggesting. And something similar, we have built very large exposure in the hotel space. Okay. Which is also, talking about 50 tourism destination, a well-coordinated effort. I think that's the one area which I'm very bullish. We talked about hotels and hospitality. Okay. And I think hotels in particular is a new segment which is emerging. Like how few years back, 4-5 years back, or maybe last 10 years, realty came as a new sector. Renewable came as a new sector. I think hotels are emerging as a new sector. That is another big beneficiary giving the focus of the current government on tourism, as well as India, if I have to talk about overall corporate growth. And even within that, the way we have seen interaction increasing, destination weddings, all sort of now, this used to happen in banquet hall. Every marriage now is happening in the 5-star hotel or 3-star hotel. So I think something has changed. Post-COVID, our habits have changed. We don't compromise now in general about the quality of stay also. So that's one change which is happening. So I think I'm very constructive on the consumption as a theme, hospitality as a theme. And within that hospitality, I think hotels in particular definitely looks good. And FMCG is a very no-brainer in terms of whatever announcement was made as of today.
Mahendra, with this budget focusing on attracting foreign investment, how do you think, global macro, that has been in turmoil and, that lot of upheavals there. So what, macroeconomic factors such as interest rates in US and Europe, you have partly answered it. But, will it really have a very significant bearing on Indian debt and equity market outlook?
It does have a bearing on the Indian debt market because we are a country with a current account deficit and we need to attract foreign capital every year to balance our capital account. So to the extent that India is integrated with the global markets, it is always affected by what happens in the global space. But there is a distinct trend that has taken place in the reaction function of the central bank of our country and the government. So if you recall in the earlier days, if there's a panic in the global markets, we would go down first, and then when the things normalize, we come back to the previous state. Nowadays, when there's a panic in the global market, our markets don't give a knee-jerk reaction, and when the panic subsides and things normalize, we go back to the next level. So that is one, I think, differentiation that has come. Our reaction function has become that of a strong country, strong central bank. The second part is that if you look at the global macro today, I think it's very clear that a new rate easing cycle has started. And that rate easing cycle is going to affect India in that direction. So our central bank is already turning more accommodative. At this moment, we are finding a lot of noise and disruption because of the change in the political, atmosphere. And there are concerns around the tariffs and the other such, issues like immigration, etc., largely centered in US. But there is a big silver line that I personally am focusing on, which is that over the last couple of years, most of the central bank had the geopolitical instability as their number one risk factor or concern. What Trump has largely already achieved is significantly sobering down the geopolitical instability. Already there is a truce between Israel and Hamas, and it is only a matter of time that the Ukraine situation should subside. So the problem or the issues have shifted from the war front to the economic front, where we are talking of tariffs, etc. My personal assessment is that when this whole thing settles down, it will work to the advantage of India for two reasons. One is that our government has already said very clearly that we are willing to look at the issues objectively and deal with government to government and work out a solution. So India is not taking a confrontational approach. And then to the extent US deviates from, say, China or Mexico, it is going to be the advantage to India because of, again, the successive measures, including today's budget, which our government is taking. So I think that in a backdrop of a global rate easing cycle, where some of the countries like US in particular seeing steepening yield curve, that's not something that should worry India because our macro is very strong, our growth is slowing down, our inflation is well contained, largely, to some extent worried because of the highly volatile food prices. So I think clearly in our country, the direction is for the central bank to turn progressively more accommodative, notwithstanding some of the issues at the fringe, which is worrying the global markets.
Not a speed breaker to the growth initiatives. Yeah.
And therefore, I think our growth, in spite of the budget and everything, I think our underlying growth momentum has slowed down significantly. Therefore, it's like a treadmill now. We have to keep running just to be at the same place. So I am pretty positive that RBI will turn more accommodative, and therefore it's a very good situation for the fixed income investors.
Ajay, coming to you, there are a lot of measures about MSME and startups. How does your funds get reconfigured, or how do you actually absorb it and reflect it in your portfolios?
So, MSME and startups, see how we look at this.
Do they get reflected in any segment of the fund that you manage?
See, they are integral part of the supply chain ecosystem. So for us, if there is an automobile company OEM, then the kind of angst they have and what is their supplier base. And I'm just giving an example of manufacturing industry. But if you look at even the garmenting industry or even the jewelry industry, even they have their own supply chain, which is backed by tier 1, tier 2 kind of players. So some of them are small guys. When we spoke post-budget to them, they are happy that they will have better access to credit. So it will help them clearly. And as far as startup ecosystem is concerned, I don't think we have many investable businesses there. But I would say what is helping is that, again, in the budget, if you look at from the supply chain perspective, wherever we have shortage of material, the basic custom duty has been reduced to help the availability of products. For example, EV. Now we are talking about startups. Some of these businesses actually are part of EV ecosystem. So, and wherever we have availability of product, we want to produce indigenously, there the basic custom duty has actually been increased. So startups are helped in a way that they are, wherever they can actually produce, we are trying to use these duties and customs to help them to produce domestically. So that is how I think the budget is helping these two segments. But from the investment perspective, I don't think there are many listed opportunities available there.
Sandeep, coming back to you, which is one big thing that you think is going to be, the real takeaway or is uplifting your mood for the outlook of your investors in this budget?
So I think what I appreciate and understand from the current budget is that government is very adaptive. Okay. When I say government is very adaptive, if you really look at, they have understood the problem. Okay. And last 2-3 months, they are trying to address. And if you look at even the economic survey also talked about deregulation in a big way. So if you really look at, we have seen a lot of stuff stand from the regulator in last maybe 1 or 2 quarters, which has really affected the sentiments also. So you're talking about deregulation on one side, Second side, you're talking about actually recognizing there is a problem in the economy. Okay, there's a problem related to consumption. See, otherwise, a lot of time you are in denial mode. Okay, you don't want to accept that something has changed. So I think that's a good part. They have accepted there is an issue, and it's a very bold step. No, in fact, we candid with you. We were talking that day also. If they do 12 lakh, this is a number we were internally discussing also. Okay, I said if you straight away from 7.5, you go to 12.5. Okay, then what you are giving one benefit on one side, then again side you are boosting the consumption and you get compensated up to certain extent in GST also. I think government is very sensible, and I think it's a very pragmatic approach, I will call it, rather than taking and the message we were very clear. If you look at Mr. Modi's body language yesterday when the budget session started, okay, and even the tweet which he has done that people should be watching and waiting for the budget, I think they have taken some good step, very, very constructive, very well balanced approach. It's not like they have compromised on the fiscal discipline. In fact, my view is that if need be, you should do it. Okay. How you have done during the COVID time when your fiscal went to 9.5 and then 6.5. I think that was the need of the hour. So every time when we look at liquidity, when we talk about public sector liquidity or the central bank liquidity is considered bad in a difficult situation, even central bank liquidity is considered to be good. Similarly, in today's context, when the consumption was the issue, economy was really struggling, and you need to boost the desired level by cutting the taxation, I think they have fulfilled. That's the reason I'm saying very, very pragmatic approach, very adaptive approach. So that's the way I will congratulate. It's a very fine balance. And if you really ask me, which we were discussing a few minutes back, the capex, what we have understood, the effective capex has actually moved up. Okay, though the normal capex is remain the flat, but if you look at the budgeted or the aid which you give, okay, the subsidy or the aid which you talked about, I think that number has gone up from 3 lakhs to 4.3 lakhs crore, which effectively means the net capex or the effective capex is now, instead of 4.1% of the GDP, is 4.3%. So we have to look into, this is what we understand. And if this is the case, I think it's a very constructive background. People should not take that negative.
Mahendra, the budget has introduced, all these initiatives, or, yesterday the economic survey also talked a lot about how mutual funds have played a very catalytic role in as channelizing savings and investments and the growth of it and providing stability to the market. And this time round, they're talking a lot about this central KYC, which has been a serious, and doing a big overhaul, which actually found quite a bit of mention in this budget speech. What is your outlook of, the retail investors and their, participation, and how big a problem is this? Or maybe even Sandeep, you might have some points in terms of, this KYC. How big a deterrent it has been while you are growing your retail business so rapidly in recent past?
So I think what we have to look at, Dhirendra, is more closely what exactly, but I think the intent part is very good. If you really look at one side, when the SEBI chairman talks about bringing down the sachet type 250 rupees sachet for the mutual fund, the challenge which we face as a mutual fund industry is that our operating cost is very high. Okay. And if you really look at a smaller mutual fund, the operating cost is as high as 20 to 27 bips. For a larger mutual fund, it is around 12, 13 bips. When I'm talking about which include the KYC costs, NSDL costs, CDSL costs, or the custody, clearing, R&T costs. I'm talking about pure direct costs.
All of it together. Yeah.
So, and every time you do a KYC, you have to spend 35 rupees. Even somebody already has a KYC, but the RT will fetch. If it's a new investor for you, they will take away 35 rupees. So it becomes very expensive to, if I'm not wrong, to onboard a person or, first time guy at our mutual fund, it costs us 75 to 80 rupees. Okay. So when you're talking about 250 rupees sachet for the mutual fund and then this 80 rupees, then business is unviable. And I think this is the one area which we have also requested to look into. The regulator and the central government should look at very closely how to bring down these operating costs. If you look at one side, the regulator talks about our tiering thing. As your corpus moves up, your effective tier will come down. Okay, so which is right step that as your size moves up, your fees will come down as a percentage, and volume terms is rising. And so should be the case with the industry also. All the intermediary, when you look at, don't look at the one mutual fund. When you look at mutual fund industry has grown to the different level, the operating cost of all these institutions, which include NSDL, CDSL, also has to be brought down drastically if you want to make this product viable for masses.
Mahendra, what is your understanding of, will debt actually take off from here? And what is your view, particularly, when it comes to fixed income? Now, fixed income will be treated, your deposits, the interest will be treated as, will be taxed as capital gains if you, at rates of capital gains, if you hold it for 3 years. How do you look at that move? On one hand, we have done away with, there's this thing that existed for mutual fund. On the other hand, we are actually extending something for the deposits. How do you look at it?
So deposits were eligible for capital gain advantage if they were to be held for 5 years. That has been brought down to 3 years. But
3
most
years,
bankers are, more keen on the CASA. So I don't think that will have a big advantage for the banks again, because 5 year to 3 year is just a more, I think, a cosmetic shift. Yesterday, we had one of the big bank chairmen talk about this possibility, and they were making the same point that we basically need CASA. And unless you are going to lend to big infrastructure projects. As far as the retail participation in debt markets is concerned, I think it's a work in progress. Right now, we have successfully in the mutual fund industry got the retail investors into the equity side. And I think once the equity side saturates, and then as the wealth level of people increase, the participation in debt will increase, because it's very well known that the investments in debt will come when people have created enough wealth and they switch to the savings and protection mode. But as far as and India is a young country, so that phase will come. In the last couple of years, there have been meaningful measures taken for encouraging retail participation in debt. So we have been able to see the lot size come down to, I think, just about 1 lakh rupees now from earlier, or maybe 10,000. I don't remember exactly. There are now a couple of very robust bond platforms which are in operation. So the cumbersome is associated with buying a debt instrument is now becoming as easy as buying equity on the exchange. So a lot of parallel.
No, RBI Direct is one such initiative too.
Yeah, but then we have not seen much of a success in terms of volumes or business with RBI Direct or these online platforms. But I think again, these are the people who do the early hard work, and the same thing was there when the mutual fund industry started. A lot of people did a lot of hard work for this stage today. So I think, but though to be fair and objective, it's a long drawn process. We had a very hyperactive retail bond market or retail FD market in the 93 to 95 period, but then after few incidents, that phase died down. It will come back, but at this point, I think there's a lot of effort going on. But I think a lot more needs to be done. There is a lot of emphasis on building up the infrastructure, but the next stage is to give people genuine incentive and reason to invest in debt markets. So that will come along with the improvement in the infrastructure, more awareness and higher awareness. Flows will flow into debt mutual funds also, which is largely right now dominated by the institutional money. But it's a journey, and we are at one milestone.
Early stages. Okay. Ajay, I have my last question for you, which is whatever has happened in this budget announcement, how sustainable is going to be the investor sentiment as a result of this? How long the market will be happy?
So I think
how happy it will be.
I think this 1 lakh crore additional income, additional money in the hands of now taxpayers, which is here. So this is something which will continue to help consumption. So I think the whole shift from unorganized to organized will continue because these salary guys generally have more access to finances also.
Yeah.
So clearly, the beneficiaries would be consumption related. Anyways, the way we are moving up in per capita curve, I think that itself brings that kind of increase in consumption. But this will clearly now shorten the arm which was needed. So some of these sectors like jewelry, durable, QSR, footwear, they will clearly see more consumption coming, and I'm sure the manufacturers will also take advantage of this benefit. The financials will take advantage of this benefit. So I think considering that we have not cut down drastically on our capital expenditure and we have balanced it with the one leg which was not working, the consumption part of it. I think market is fairly balanced and the result season so far has been actually better than the expectation. When entering into the result season, people had a lot of questions and doubts about how earnings are going to be this quarter. So the things have been fairly decent on the ground in terms of the consumption and business delivery. And now on top of it, we have this something which is really exciting the market. I believe that this is good time for investors.
This will leave a lingering smile for all of you. Thank you very much for spending time on a busy day and looking forward to more eventful days ahead for you. Thank you.
Thank you.
Thank you, Kiran.
Thank you.
Thanks, guys.